This year, we have conducted our third survey on the infrastructure investors market, analysing the state of the sector today and how it's likely to evolve going forward. At the publication of our last report back in 2010, industry commentators were querying whether the infrastructure fund model would even last, as LPs started to find themselves long on allocations. Today, however, I'm pleased to say that the picture looks very, very different. Funds have emerged stronger from the crisis, and momentum across the sector is building as new investors continue to enter the marketplace.
In terms of portfolio performance, the findings are positive. Investments have appeared resilient to the downturn, and the funds of 70% of those interviewed are now performing at or above target IRRs. In many of the cases, this strong performance reflects an increasing focus on asset management, and in particular managing leverage. 41% of funds have recruited dedicated asset management teams, which on average now comprise just over a third of their total workforce. We've seen a notable shift in the competitive landscape since our last survey, with the rise of the direct investors. Contrary to expectations at that time, directs have significantly increased their expertise and resource pool over the last 3 years, such that the larger US and European funds increasingly view them as their principal competition. In parallel, we're also seeing a short supply of infrastructure assets coming to market, as several large asset disposal programs have yet to transpire, leading to increasing competition across the sector. To counteract this lack of deal flow, investors are increasingly focusing on partnerships with corporates as a source of bilateral opportunities and beginning to pursue innovative strategies, such as investing in non-core asset classes and geographical markets. A small number are also considering increasing their fund allocation to greenfield investments or shifting their services towards providing a managed accounts offering.
Undoubtedly, the fundraising market remains challenging, with more and more funds than ever seeking capital. However, there is increasingly good evidence capital is engaging, and more closings are now occurring than back in 2010. Not surprisingly, in this increasingly competitive environment, there continues to be a great deal of scrutiny on fees and fund terms. However, fee structures have not really evolved significantly since 2010, and interestingly, appear to have resisted further downward fee pressure. In terms of securing investment, funds are observing that performance of existing portfolios, co-investment rights, portfolio management capabilities appear to be the most important criteria to LPs when they're considering which funds to invest in. Interestingly, alongside that, LPs are now undertaking significantly more diligence before committing to funds. Looking forward over the next 2 years, the clear investment focus for the majority of infrastructure investors is basically more of the same. Regulated utility and transport assets remain attractive. However, there's clearly a recognisable concern around the regulatory environment and the risk that brings. There is, however, a noticeable reduction in appetite for PPP and waste assets, while telecoms is becoming increasingly more attractive. In terms of the geographical focus, Western Europe, particularly the UK, Germany and Scandinavia, continue to attract strong investment. We are also seeing an increasing appetite amongst funds to deploy capital outside of Europe, but interestingly, that does not include India and China, where the appetite appears to have dropped off as their growth has slowed.
Looking further ahead, the momentum across the sector will continue to build. We expect to see a greater number of exits as first-generation funds reach maturity, with the preferred route exit via auction to secondary or trade buyers. Also, it'll be interesting to see if the recent uptick in appetite for IPOs will translate into the infrastructure sector. The rise of direct investors will push incumbent funds to pursue more innovative strategies to differentiate themselves. These may include targeting peripheral infrastructure assets and geographical markets outside of Western Europe. And better partnering with corporates will be important to access bilateral opportunities. The population of buyers in the market will continue to expand, with the emergence of two new populations in particular: Asian direct investors and European insurance companies taking a greater interest in the market. So what does this all mean for pricing? we expect there will continue to be an excess of capital chasing core infrastructure assets, as the supply of assets will increase, but not at the pace of new entrants to the market. Prices will therefore remain high, and the challenge for incumbent funds will be to differentiate themselves in this increasingly competitive marketplace.